This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 14, 2026, and this is the New York pre-market. Now, let's get into it. IBM collapsed 21% in pre-market trading, triggering a sector-wide panic that has dragged the Nasdaq 100 down nearly 2%, while the S&P 500 barely scratches the surface. We are witnessing a violent rotation from high-multiple technology into energy and financials, with the VIX quietly expanding as the market digests a revenue miss that many are calling a bellwether for the entire software complex. Looking ahead to the immediate schedule, we have monthly options expiration arriving on Friday, July 17th. This 4-day expiry cycle often amplifies gamma sensitivity and can exacerbate intraday swings, particularly in volatile tech names as dealers adjust their hedging books. In terms of corporate catalysts, the entire financial sector reports today, with JP Morgan Chase, Goldman Sachs, Bank of America, Citigroup, and Wells Fargo all printing earnings estimates ranging from $1.13 to $14.47 per share. This synchronized reporting window will serve as the primary stress test for the flight to safety trade, determining whether capital is genuinely flowing into banks as a defensive haven or simply waiting for confirmation that credit quality remains intact.
And for that financial print, the key metric to watch is not just the bottom line, but the net interest margin compression. If margins hold steady despite the macro headwinds, it validates the strength we're seeing in the financial sector right now.
Turning to the opening board, the data tells a story of bifurcated markets. The SPY sits at $749.17, down 0.77%, while the triple Q has taken a heavier beating at $711.74, off 1.9%. The diamonds is relatively calm at $524.47, down just 0.25%, but the IWM is showing early weakness at $293.48, off 0.85%. The sector lens paints a starker picture. The technology sector, is lagging at -2.42%, while the energy sector, leads the pack with a solid 3.1% gain. We have a classic risk-off dynamic playing out live, and the question is whether this is a healthy digestion of the IBM miss or the start of a broader trend reversal. The headline mover is undeniable. IBM is down 21.1% to $229.09 after missing Q2 revenue expectations. The contagion is visible immediately in the software complex, with Salesforce tumbling 5.7% to $161.43 and Service now dropping 7.4% to $103.01. Simultaneously, the market is piling into defensive yields, pushing the energy sector to $56.74 and the financial sector up 0.65% to $56.07. Pulse, how is the sentiment data reflecting this specific shift?
It's reflecting a regime change, not just a correction. The VIX has expanded from a 5-day low of 14.96 to a current reading of 15.3, with an upper bound reaching 18.91. That expansion signals the quiet period is over. More importantly, look at the sentiment divergence. Apple is carrying a bearish sentiment score of negative 0.33 across 12 articles, while Google retains a robust bullish score of plus 0.53. And critically, NVDA sits neutral with a plus 0.17 score, despite 57 articles. The fear is concentrated in legacy enterprise software, not the entire AI infrastructure stack.
So the sentiment isn't uniform across tech, it's targeted. Grid, from a technical standpoint, does this concentration of fear in software create a structural break in the triple Q, or is the index holding together because of its other constituents?
The triple Q is at $711.74, which places it just 10 points away from its 10-day low of $700.91. That is a critical proximity. However, the SPY at $749.17 is testing the lower bound of its own 10-day range, having previously consolidated near $755.42. The key here is the divergence. The triple Q is dragging on a negative 1.9% move, while the SPY is only down 0.77%. That means the technical breakdown is being absorbed by the weight of the tech sector. If the triple Q breaks $700.91, we expose a major structural floor. But right now, the price action is actively seeking lower liquidity pools.
I'd argue you're looking at the symptom, grid, not the disease. The SPY is down less than half of the triple Q precisely because the underlying asset composition is rotting. The technology sector is down 2.42%, yet the broader index is only down 0.77%. That discrepancy proves that non-tech components, specifically the energy and financial sectors, are propping up the S&P 500. You aren't watching a general market correction. You're watching a quality deterioration where the index is being artificially supported by value plays while growth multiples get compressed.
That raises the structural risk question. SPECTER, if the S&P 500 is being held up by non-tech sectors, what happens if those defenders falter? Are we seeing signs that the bond market is already rejecting this equity narrative?
We absolutely are. The danger lies in the yield curve. The 10-year yield is at 4.56%, converging dangerously close to the 2-year yield at 4.21%, leaving a spread of just plus 0.36 basis points. That flattening is a historical precursor to economic slowdowns, combined with core PCE sitting at 3.41% and CPI at 3.46%, both well above the Fed's 2% target. We have a stagflation-light environment. This doesn't just punish growth, it crushes the multiple expansion that software companies rely on. The equity sell-off isn't just about IBM's bad quarter. It's a repricing of risk in a world where rates remain restrictive and inflation is sticky.
But SPECTER, you're missing the nuance in the capital flows. While the curve is flat, the actual institutional positioning shows this isn't a blanket exit. Look at the semiconductor decoupling. MU is up 5.5% and MRVL is up 5.6%. They are bucking the broader tech downtrend. The smart money isn't exiting tech. They are forcing a liquidation of non-AI correlated assets. The IBM miss is being treated as an idiosyncratic failure of enterprise execution, not a collapse of demand for AI hardware.
That hardware decoupling might help, but the technical reality for the software names is brutal. ServiceNow at $103.01 and Salesforce at $161.43 are gapping down. From a chart perspective, when you see high-volume gap downs in names like IBM and HCA, you are looking at institutional deleveraging, not retail noise. The path of least resistance for these names is downward until they find a new equilibrium. The gravitational pull on the triple Q is coming directly from the technology sector weight, which is down 2.42%. Until those names stabilize, the technical structure for the index remains vulnerable.
Let's drill down into the primary driver, IBM. It's at $229.09, down 21.1%. CIPHER, how do you interpret the fundamental shock here? Is this a one-time miss, or is the market repricing the entire SAW model?
The market is treating the miss as a proxy for broader SAW demand weakness. It's not just IBM. The bleed extends to CRM and Now. When you combine that with the fact that the 10-year, 2-year curve is flat and CPI is sticky, the fundamental math stops working for high-multiple software. Investors are abandoning valuation multiples for commodity and financial stability. The financial sector is up 0.65% today, and with 5 major banks reporting earnings estimates ranging from $1.13 to $14.47, capital is actively rotating into yields. This is a structural pivot from growth to value, not a temporary glitch.
And CIPHER, that pivot is confirmed by the sentiment scores. NVDA is neutral, Goog is bullish, but Opal is bearish. The fear is localized to the legacy enterprise software layer. However, I'm worried about the durability of this rotation. If energy fails to hold its gains while IBM continues to bleed, that defensive posture becomes exhausted.
Which brings us back to the risk pulse. You mentioned the semiconductors are bucking the trend, but let's look at the broader implication. If the yield curve compresses further below plus 0.3 basis points while equities fall, we expect a sharp reversal of flows back into bonds. In that scenario, even defensive equities like the utilities sector become less attractive than cash or short-duration treasuries. The risk here is that the safe haven trade is crowded. If everyone is piling into the energy sector and the financial sector simultaneously, a sudden macro shock could trigger a liquidity crunch in those very sectors.
But SPECTER, you can't short the flow. The price action is telling me that the technology sector is underperforming the energy sector by 5.43 percentage points. That is a massive spread. The market is voting with its wallet. The technical evidence shows that until the triple Q stabilizes above $715 or the SPY holds firmly above $745, the path of least resistance is downward. The IBM gap down has created a vacuum, and price is filling it.
Let's look at the secondary wave of this story, the small cap and industrial response. The IWM is at $293.48, down 0.85%, and the industrial sector is down 0.85% today, though it's already down 2.8% for the week. How much of this tech capitulation is spilling over into the broader economy?
The IWM is hovering just 2.8 points above its 10-day low of $290.68. That mirrors the triple Q pressure perfectly. It suggests that the risk-off sentiment is permeating smaller cap structures. This isn't just big tech, it's the entire growth spectrum. The small caps are showing relative weakness compared to the large caps, which reinforces the idea that this is a de-risking event, not a liquidity crisis yet.
Agreed, but look at the earnings calendar for the industrials. AA reports tomorrow with an estimated earnings per share of $2.09. If the industrial sector continues to underperform on a weekly basis, it confirms that the slowdown is real. The stagflation-light narrative SPECTER mentioned is starting to show up in the order books. Companies are pulling back on CapEx, which hits industrials and software equally.
Finally, let's touch on the outliers. We have the energy sector leading at plus 3.1% to $56.74, and the utilities sector up 0.68% to $45.72. Meanwhile, consumer discretionary is down 1.2% to $116.04. Apex, synthesize this for us. Where is the safe harbor in this environment?
The safe harbor is clearly in the sectors offering yield and defensiveness, but with a caveat on timing. Grid flagged the critical nature of the $700.91 triple Q support level, and CIPHER highlighted the fundamental rotation into financials via the financial sector's strength. However, SPECTER correctly warned that if the yield curve compresses further, bond-like equities lose appeal. The current data shows a 5.43 percentage point spread between the laggard, the technology sector, and leader, the energy sector. The market is aggressively favoring defensive yields. The best statistical shield right now appears to be the financial sector, given the upcoming earnings prints, provided that the credit quality holds up against the flat curve risk.
So, to summarize the morning briefing, the market is executing a forced rebalancing away from growth and toward value. IBM's 21.1% collapse has triggered a contagion in the software complex, dragging the triple Q to within striking distance of its $700.91 technical floor. Meanwhile, the S&P 500 is being propped up by defensive rotations into energy and financials, as evidenced by the energy sector outperformance and the flat 10-year, 2-year yield curve signaling stagflation-light risks. Volatility is expanding, and sentiment is diverging between legacy software and core AI infrastructure. What to watch next? As we enter the final hour of pre-market trading, monitor the reaction in the triple Q as it approaches $700.91. Does it hold as a technical base, or does the IBM shock push it into uncharted territory? Also, keep a close eye on the financial sector earnings prints later today. If the financial sector begins to weaken amidst the tech sell-off, the defensive thesis collapses. Otherwise, expect continued volatility as the market digests the new regime. Thank you for listening to the ShadowQuant Equities edition. Remember, this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.